markets were very enthusiastic after the election because they saw a pro-business administration, a cabinet that had a lot of what they looked at as market-friendly folks, and what they viewed as a Trump put, which would be there would be downside protection to stock markets. And I think that carried over for most of the start of this year. It's become evident that consumers and businesses have become a little more uncertain because of tariffs and the effect it's going to have on the economy. So the economy is slowing. And then measures like DOGE, which have really cut a lot of federal spending, and some of these programs like US aid are potentially leading to a softening of the economy itself. And so now investors are wondering, are these Trump initiatives actually good for markets? And that's why we've had many stocks come under pressure.
Lee remains constructive on digital assets. He views blockchain technology as a powerful innovation in a world that increasingly lacks trust. As digital assets evolve into alternative payment systems, Bitcoin's role as digital gold becomes more prominent. According to Lee, Bitcoin holders and supporters see it as a store of value, much like gold. One of the most intriguing aspects of Lee's analysis is his speculation on Bitcoin's potential role in U.S. strategic reserves. If the U.S. government were to own a significant amount of Bitcoin, possibly 1 million BTC, it would become one of the largest holders after Satoshi Nakamoto. This would give the government substantial influence over the network.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Both consumer confidence surveys, University of Michigan and Conference Board, the respondents have listed tariffs and the uncertainty around that and DOGE as a bigger concern than inflation. In the regional Fed surveys, many businesses have talked about how they're uncertain if tariffs happen, if they can pass on those price increases, and it is causing them a lot of uncertainty. And then if you look at earnings transcripts for both S&P 500 or the broader Russell 3000, comments about tariffs are at 7-year highs. So there is clearly a lot of uncertainty, and uncertainty, of course, causes people to slow down their activity. We're constructive on digital assets. We think blockchains have really proven to be a trusted vector in an increasingly trustless world. And if digital assets become a form of an alternative payment system, and Bitcoin is viewed as digital gold by buyers of Bitcoin and people who hold and support the network, then it makes perfect sense for governments to actually treat that as a commodity that they do want to have some control over. If the U.S. owns 1 million Bitcoin, which could be, what the strategic, we really don't know the composition and how much Bitcoin they'll own, but if they own 1 million Bitcoin, they would be the largest holder of Bitcoin in the world after Satoshi. That would allow them to exert significant influence on the network. So I think it makes a lot of sense if you look at financial instruments, and if Bitcoin becomes increasingly viewed as digital gold, that the U.S. should have a strategic reserve of Bitcoin. None of the major G7s have done something like this. El Salvador comes to mind, and it's been a success story for them because El Salvador actually has one of the lowest funding costs for any country. I do think there is a strategic value in the U.S. owning a commodity that actually could rise in value, because it does change the way markets eventually see the U.S. deficit. Because if Bitcoin is something that is rising and the U.S. owns 1 million of Bitcoin and they're going to hold it for 20 years, that in some ways could actually offset a lot of the deficit. In general, when an index, a global index or a regional index like the DAX or China has strength in the first few months of the year, that's a good sign. So I think investors do have to view that as a credible rise. And if Europe is outperforming year to date, I would, barring any geopolitical shift, it probably does signal that Europe could outperform the US this year. Is it making sense that that's happening? I mean, in some ways, I'd say yes, because Europe is more of an industrial and financial economy. So the banks and industrials are larger weights. in those indices, a lot less healthcare and a lot less technology. If the global economy is bottoming, so not considering tariffs, but just looking at what's happening with the ISM and the global PMIs, it makes sense that Europe should outperform. The dollar, if it's weakening, probably is favorable for non-US equities. And as far as tariffs go, in some ways, I'd almost say that what's happening in Europe and also in Asia might just signal that the market doesn't believe tariffs are permanent changes in the sort of global financial architecture, but at the moment are negotiating tactics. And that, of course, the market could ever rethink of that. I think if we start from a high level, as long as the economy's in expansion, and as long as there's firepower on the sidelines, meaning investors aren't over-invested in stocks, stocks should continue to rise. And that's been really the right way to look at markets since 2009. If the business cycle matures or experiences a shock in a way that triggers a recession, and it's one that begins to look really severe, then markets can't go up anymore. In other words, we could have a growth scare this year. And I think that's what's really, this is all shaping up to be. And because we could have 1 or 2 weak job reports, Fed starts to ease faster, and it prevents the economy from stalling. But if we have a full-blown recession, that's going to be hard to be recommending stocks. That's not the case, and that's not really what we're expecting. I think the second thing that would change our view is if stocks become overvalued. And there's many ways to measure it, but to me, as long as the PE of the stock market is below the PE of the bond market, I don't think stocks are expensive. The 10-year yield is 4.3%. That's roughly 23, 24 times earnings. The median PE in the S&P is 17 times. So the stock market is still cheaper than buying a 10-year treasury.
The Federal Reserve plays a critical role in shaping market sentiment. Chair Jerome Powell leads by consensus, and recent Fed minutes indicate uncertainty regarding tariffs' long-term effects. Short-term inflationary pressures exist, but the broader economic impact remains unclear. For now, the Fed remains on hold, which markets perceive as a hawkish pause. If labor market conditions weaken, the Fed would likely shift to a more accommodative stance, which could provide a tailwind for stocks. Lee points out that valuations remain reasonable. The S&P 500's median price-to-earnings (PE) ratio is around 17, while the 10-year Treasury yield equates to a PE of 23 to 24. This suggests that stocks are still cheaper relative to bonds, reinforcing the idea that equities remain attractive.
I think Fed Chair Powell himself is, on balance, slightly dovish, but he does lead by consensus. And it's apparent when you look at the Fed minutes, the discussions at these meetings, that many FOMC members are just uncertain of the consequences of tariffs and the new policies. On the surface, they realize it creates short-term inflation pressures, but the long-term consequences are unknown and possibly would slow the economy. So I think that the Fed's decision is really to be on hold until they have visibility. The market views the Fed on hold as a hawkish pause at the moment, meaning the Fed realizes the employment market isn't creating inflationary pressures, but the current inflation environment isn't necessarily convincing them that inflation is set to cool again, especially with tariffs. I think that this whole conversation will change if the labor market begins to soften. So coming back to Doge, it's possible that it's either the February or the March employment reports begin to show the negative effects of these layoffs and these terminations. And if that's the case, this will pull the Fed off the sidelines. And so the Fed has to go into full dovish mode. Well, there's quite a lot of important things happening this week, actually. It's not just tariffs that are going to go into effect tonight. And I think in some ways the market's priced that in because we've been expecting it. There should be no surprise it's happening. The surprise, of course, would be tonight if there is a stay of execution. Somehow there is a breakthrough in the negotiations. Tomorrow, the president makes an address to the nation. On Wednesday, Scott Bessent is speaking at the Economic Club of New York, and that's going to be very widely watched because the Trump put is something people are wondering. We've had so many conversations with investors lately wondering if the White House is measuring their success by lowering interest rates, what does that mean for stocks? That's his chance to really talk about that. And then on Friday is the jobs report for February, and then Fed Chair Powell is speaking at 12:30, 4 hours after that jobs report comes out. So this week is a lot of important things happening that are going to be very closely followed. Well, there is going to be a break point, because if the economy becomes uncertain and consumers sit on their hands or confidence falls and businesses slow expansion, the economy risks going to stall speed. And nobody wants the economy to go to stall speed, because if you enter a recession, it'll force the administration to unwind everything. Because as you know, when you have a recession, you have to have fiscal expansion, meaning no austerity, spend a lot of money, and it reverses all the things that the administration is trying to accomplish. And similarly, the Fed wants to avoid stall speed, because instead of worrying about full employment and inflation, if employment starts to weaken, the Fed has to go into easy money right away, which means a put, of course, exists at a certain level.
At a certain level, right. Do you have a sense that, I mean, for, I guess, us in the finance community, we think Bessent is probably the smartest guy in the room. Do you think he has a good voice in this administration? If he says something, is the president likely to listen to saying, we may be approaching stall speed if you do this?
Yeah, I think he's got a lot of credibility. I think that his cabinet is not bureaucrats or career politicians, but people with private sector experience that he does respect, just like Trump has clearly demonstrated a lot of respect for Elon Musk. I don't think it's lost on Bessent that markets will clearly indicate the level of stress before we start to reach stall speed. And I think that's why I don't think stock markets have to feel that there's unlimited downside if the economy starts slowing.
Several critical events could influence markets in the near term. Tariff implementations, a potential White House intervention, and upcoming speeches from key policymakers, including Fed Chair Powell, will be closely watched. Additionally, employment reports will provide insights into whether recent economic slowdowns are translating into labor market weakness. If employment data weakens significantly, the Fed may have to pivot toward an easier monetary policy. This shift would be crucial, as a recession would force policymakers to reverse austerity measures and increase fiscal spending. A proactive approach by the Fed could prevent the economy from entering a prolonged downturn. Please like and subscribe.